Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Investec's Jeff Boswell to talk about rising interest rates. Hi, Jeff.
Hi, morning, Emma.
So I thought we'd start with a cheeky question. Predictions for the rest of the year. What can we expect from central banks? Let's start maybe here in the UK. Will the Bank of England put up rates again?
Yeah, look, my crystal ball, unfortunately, is a little bit hazy, but I think from a UK perspective, I think you've got to look at the factors that they're facing, and I think Brexit, unfortunately, hangs over them, and such that even if I think we start to see a bit of a pickup in growth and we see a bit of a pickup in inflation, they're gonna be apprehensive in terms of going too quickly. I think, and this is a dilemma facing any central bank, I think to the extent inflation really starts to kick up, then they're going to feel they need to move. But I think if you look at actually what's priced into the market, certainly from a UK perspective, I think the broader market is saying there's only a 30% of chance of another hike by the time we get to actual Brexit next year.
And what about the US then? Perhaps a little more clear there.
Absolutely. I mean, the US, even though we had a weaker inflation print yesterday, the US is rollicking along, certainly from a growth perspective. And we've seen that coming through in terms of corporate earnings as well. So the risk in the US is that there's really a surprise to the upside from an inflation perspective, and then they feel they're slightly behind the curve. From a credit investor standpoint, this kind of looks like a normal cycle whereby, the Fed will tighten until they go one tightening too far, and then obviously the markets react quite violently to that. But the Fed, I think, they're going to be driven more by data, and it's going to be how's growth actually developing, and do they have any inflation surprises?
Now, how much do markets get impacted by rate hikes, given that we do seem to have quite a lot of insight into what central banks do? I mean, ever since the taper tantrum, central banks like to really signal their plans now. And so for bond investors and indeed, all asset investors, because everything's connected, does a rate hike really make that much of a difference anymore?
I think the central banks are doing whatever they can to signpost it in terms of trying to make sure there is no surprise. And, the ECB with Draghi is the best example of that. I think where markets will react adversely is to the extent, to exactly as we were just talking about, there is a surprise, an inflation surprise to the upside, and they have to move quicker. Because as an investor, certainly as a credit investor, it means we're a step closer towards the end of the cycle. And I think that's what you're always worried about. So it's, there's an element of picking up pennies, because that if the Fed keeps going, eventually it gets to a point where financial conditions are tightened to such an extent that it has a real impact on the economy. And that's really what you're grappling with as an investor. So I think to the extent that we stay on the course and they keep signposting things and there's no surprises from a growth perspective, the markets could carry on trundling on. But there is obviously a risk to the downside as well.
It must mean that you are obviously data crunching as well as an investor, not just leaving that to the central banks. You've mentioned inflation as one kind of signpost that may be a red flag. Are there any other particular figures, jobs figures, for example, that you as a credit investor are watching to get some insight into what happens next?
Absolutely. Well, certainly, across the macro spectrum, we've got a team of people that are continually crunching numbers. The interesting thing is, I think inflation is in our mind what's front and foremost in terms of most central banks' minds. And I think certainly from a US perspective, if you look at that, we've had the biggest fiscal stimulus package in terms of the tax cuts at full employment in history. And that undoubtedly has had a knock-on in terms of economic activity and corporate profits and the like. And so, naturally the knock-on to that is with full employment and with that fiscal stimulus, there's going to be a knock-on to inflation. And that's really, I think, why a lot of people talk about inflation. We look at a variety of other metrics. I think from a credit investor perspective, the one thing that we're all worried about is in this world where we're moving from QE to QT, we talk about rate rises being a part of that, but part of it is obviously asset purchase programs and the like as well. In this world of moving from QE to QT, there is just liquidity being withdrawn from the market. So, and that in itself is having an impact on financial markets, and certainly the weaker elements of the market, we've already started to see some cracks.
Jeff, thank you very much.
Thank you very much for your time.
This is Emma Wall from Morningstar. Thank you for watching.